Have you ever looked at your savings account and wondered if your money could be doing more? Imagine you've been doing everything right. Every month, you set aside some money. Maybe it's $100, maybe it's $200. Over time, your savings start growing, and you feel proud because you're finally building financial security. Then one day, you check your account balance and notice something surprising. You've accumulated $10,000, but after an entire year, you've earned only a tiny amount in interest. At the same time, you keep hearing people talk about investing, stock markets, index funds, and compound growth. That's when a question starts to pop into your mind. Is keeping all my money in savings really the best move? The truth is, saving money is an important first step, but it's usually not enough to build significant wealth on its own. And that's exactly where many people get stuck. They understand how to save, but they don't know how to take the next step and start investing confidently. In this video, I'll show you a simple path that can help you move from saving money to investing it without feeling overwhelmed. Before we go any further, let's clear up one important misconception. Saving and investing are not the same thing. They serve completely different purposes. Savings are designed to protect your money. Investments are designed to grow your money. Think of it like this. A savings account is a parking spot. An investment account is a vehicle that's moving toward a destination. Let's look at a quick example. Suppose you place $10,000 into a savings account, earning 1% interest. After 1 year, you'll have around $10,100. Now imagine that same $10,000 is invested and earns an average return of 10% annually over the long term. After 1 year, it becomes $11,000. At first glance, the difference doesn't seem life-changing, but time changes everything. After 20 years, that savings account may grow to roughly $12,000. The investment account could be worth more than $67,000. Same starting amount, completely different result. This is why investing plays such a major role in wealth creation. But if investing is so powerful, why don't more people do it? The answer has very little to do with numbers. It has a lot to do with emotions. Saving feels comfortable. Investing feels uncertain. Money in a savings account doesn't jump up and down every day. Investments do, and that movement makes many people nervous. Maybe you're thinking, what if I lose money? That's a reasonable concern. Which is why the transition from saving to investing should happen gradually, not overnight. Step 1 is building an emergency fund. Before investing, make sure you have enough cash saved to cover 3 to 6 months of living expenses. This money should stay accessible. Its purpose isn't growth. Its purpose is protection. Unexpected expenses happen. Cars break down. Jobs change. Life gets expensive. An emergency fund gives you a financial safety net. Step 2 is creating 2 separate categories for your money. The first category is security money. The second category is growth money. Security money stays in savings. Growth money gets invested. This simple mental shift helps many people feel more comfortable because they stop expecting investment money to behave like savings money. Step 3 is starting small. One of the biggest myths about investing is that you need a lot of money. You don't. Many investment platforms allow you to start with surprisingly small amounts. The goal isn't to become rich overnight. The goal is to develop consistency, because consistency often matters more than starting with a large amount. Step 4 is keeping things simple. Many beginners make investing harder than it needs to be. They chase complicated strategies and try to predict market movements. In reality, simple approaches often outperform complicated ones. That's why many long-term investors choose broad market index funds. Instead of betting on a handful of companies, index funds spread your money across hundreds of businesses. This provides diversification and reduces risk. Even legendary investor Warren Buffett has frequently recommended low-cost index funds for everyday investors. Now let's talk about the real secret. It's not picking the perfect stock. It's investing consistently. Imagine investing $300 every month. If those investments grow at an average annual rate of 8%, after 25 years, you could have roughly $285,000. Yet you only contributed around $90 in yourself. The rest came from growth and compounding. That's the power of allowing your money to work for you. Of course, investing won't always feel comfortable. Markets rise, markets fall. Headlines create fear, but successful investors understand something important. Short-term volatility is normal. Long-term growth is what matters. Think about investing like planting a tree. When you first plant it, nothing impressive happens. Days pass, weeks pass. Sometimes it seems like no progress is being made at all. But beneath the surface, roots are growing. Years later, that small seed becomes something much larger. Investing works in a similar way. Results are slow at first, then growth begins to accelerate. And what about market crashes? They happen, they always have. But long-term investors often view downturns differently. When prices fall, regular contributions can buy more shares. And when markets eventually recover, those additional shares can boost future returns. That's why experienced investors focus on years and decades rather than daily market movements. So let's quickly recap. First, build an emergency fund. Second, separate safety money from growth money. Third, start investing with small amounts. Fourth, focus on simple long-term investments. And fifth, stay consistent and allow compounding to do its job. Because at the end of the day, saving money creates security. Investing creates opportunity. And when you combine both, you give yourself the best chance of building a stronger financial future. Now let me ask you the same question we started with. Is your money simply sitting in savings, or is it also working for you? The answer to that question could have a huge impact on where you are financially 10, 20, or even 30 years from now.